What's up, Edge Traders? This is Adam Winnig, and in this video, I am surely going to blow your mind. I'm going to be talking about a little concept called asymmetric compounding, which is a money management strategy that you can attach to any existing trading strategy and can be almost infinitely more profitable. And it's so powerful that it can even take a losing trading strategy and can actually make it profitable and winning. It only has to do with your money management strategy. So this is going to blow your mind, and I promise you that. So let me just jump in, and I want to first show you how powerful this is, and then I'll show you how it actually works. So right here, I have a Monte Carlo simulation pulled up. If you're not familiar with this, basically Monte Carlo simulation is basically going to run like tens of thousands of simulations all in the background while I'm doing this. This is used a lot and statistical different models a lot in trading, so you should probably get familiar with it. It's called Monte Carlo. Anyways, with that being said, here's the power of asymmetric compounding. Ready? Okay, so this is how it works. We're going to go ahead and just take, for example, a $10,000 starting balance. We're going to say that we have a system that wins 33% of the time. So that means that 1 out of every 3 trades we win, the other 2 we actually lose. Okay, we're going to risk on average 1, and our reward is going to be 3. So that means that our risk per trade is 1, and on a winning trade, we're actually going to win 3%. Okay, now we're going to run this simulation over 100 different trades. Okay, and again, it's randomizing all of these variables, and it's going to spit out a number for us. It's going to show us the max consecutive losses, max consecutive wins, and then it's going to do regular compounding versus asymmetric compounding. Okay, so regular compounding is just as we know it. We're going to risk 1% to make 3%. Okay, next trade, we're going to risk 1% to make 3%. Next trade, we're going to risk 1% to make 3%, right? And then versus our asymmetric compounding model, which you're going to see here, is significantly more profitable almost always. So again, I'll just click submit. It's going to run the script in the background. It's going to like do tens of thousands of different randomizations and different calculations basically to show us a scenario of what is likely to happen if you were to have a 1-to-3 risk to reward ratio and to have a 33% win rate. So here it's going to go and it's going to spit out a new number for us. Okay, so it's just spit out this calculation, and you can see here that with the regular compounding method, again, we're risking 1% to make 3%. It made 17,155. Well, this is the ending balance. We started with 10,000, so it basically made $7,155 profit. With asymmetric compounding, it made an additional $8,000. So it made almost 100% more than it did simply by changing our money management strategy. As you can see here, it took a $10,000 account, and after 100 trades, it ended up with $25,000. So let's take a look at another scenario here. I'm just going to click submit, and it's going to run this script in the background. Okay, and again, here's another scenario. We risk 1% to make 3%. Over 100 trades, and you can see here with regular compounding, you just made basically $4,000 after 100 trades, but with asymmetric compounding, you made nearly $8,851 after. So the ending balance was $18,851. This is just crazy. This is mind-blowing. I mean, you're like 100% more profitable using this asymmetric compounding model versus just using regular compounding. So now you're probably wondering, well, that's great, but how does this actually work? So I'm going to explain to you how this works, and before I do that, I'm actually going to preface it by saying that it almost always will make a strategy more profitable in my testing. It just does. This is something that I learned from a guy named Walter Peters, who wrote this book called Naked Forex. He doesn't talk about it in the book for whatever reason. Again, it's just so powerful. So with that being said, the pros of this are it is going to for sure, well, not for sure, I can't say anything for sure, but I mean, in all the testing that I've ever done, it's going to make you a lot more money. It's going to be a lot more profitable over time. The cons are it's a little bit more psychologically difficult to trade. Okay, because your account balance is not going to be as steady, but you are going to make these huge windfalls of profits, which I think make it totally worth it in my opinion. So let me explain how asymmetric compounding actually works. Okay, so the first thing that we need to do is we need to go ahead and we need to define R. And R is basically going to be whatever we're going to risk per trade. So let's say, for example, we're going to risk 1% per trade. Okay, so R is 1. And our reward is, again, we're going to have a 1-to-3 risk to reward ratio. You can actually use this with a 1-to-2 risk to reward ratio. You can do a 1-to-4 risk to reward ratio, whatever it is that you want to do. But in this scenario, just to show you guys simply, I'm going to risk 1% in order to make 3%. Okay, really simple. So here's the rules of asymmetric compounding and actually how it works. So the first trade that you take, you're going to risk 1%. okay? You risk this 1%, and if you win, then you win 3%. And the whole goal, again, with asymmetric compounding is the goal is to basically win 2 trades in a row. So have 2 winners back to back. That's the goal of asymmetric compounding, okay? So let's say that we risk 1% in order to make 3%, okay? If this happens, boom, we're up 3%, right? Beautiful. Well, what you do in asymmetric compounding, if you have a winning trade, you risk your earnings, which again, your earnings was 3 plus your R, which is 1. So you're going to risk a total of 4% on the next trade. Now, the reason why this is beautiful is because if you do lose this trade, you're going to lose 4%, but you just gained 3%. So your account balance is only down 1%, which is no big deal. However, if you risk 4% and we're doing a 1-to-3 risk to reward ratio, if we win this trade, then now we're going to be up 12%. Because we risk 4, we make 3, we're up 12%. And that would put us up a total of 15% literally after 2 trades. And the worst case scenario was we won this trade and then we lost this trade and we'd be back down only negative 1%. So this is really, really powerful. Now, after you win your 2 trades, like we just did, we just won our 2 trades, then you want to revert back to the original R. You just want to go back and begin risking again another 1% per trade. So let me show you how this plays out. We'll just do a bunch together. So let's say that we risk 1%, okay, again, in order to make 3%. Okay. And let's say that we lose this. Well, what happens? Now we're down 1%. So we're only up 14%. Boo-hoo, right? Let's say again that we go and we risk 1% in order to make 3%. And we lose it, okay, down 1 more percent. So we're down 13%. Let's say we risk 1% to make 3%. Let's say that we lose it. Okay, we're down to positive 12%. Okay, not bad. Now let's say we risk 1% again, and this time we actually risk 1% to make 3%. Let's say that we actually make it. That's great. Okay, so now we are going to be up 15% again. Okay, then what do? We want to trade, so we want to do the asymmetric compounding. We take our earnings, which is 3%, plus the 1%, which is our original R. We're going to risk 4%. And let's say that, for example, we're risking 4% in order to make 12%. Let's say that we don't win this trade. And let's say that we lose it. Okay, well, that happens. Okay, now you're back down to positive 11%, right? And the game just continues this way. Let's say, again, you risk 1% in order to make 3%, okay, and you lose it. Okay, now we're only up 10%, right? Now, check out how powerful this is. All we need to do is we need to win 2 in a row. So, again, watch this. We risk 1% in order to make 3%, okay, and we do that. Okay, now we're up 13%. What do? We take our earnings plus the original R1, so we risk 4% in order to make 12%, and when you do that and you actually win the trade, okay, now you're up a total of 25%, right? So you have these huge jumps in profitability when you use a compounding model like this, like asymmetric compounding. Now, with that being said, by the way, this is really great for growing small accounts. If you're trying to grow a small account, this is really, really phenomenal way to do so. But again, it is a little bit more psychologically difficult, but it is just, I mean, in my testing, it seems to be, I mean, in all of our testing and actually doing it's way more profitable. That's that. Now, the same thing, guys, right? If you want to do 1 to make risk 1 in order to make 2. So 1-to-2 risk to reward ratio, it works the exact same way. So let me show you just really quickly. You risk 1 in order to make 2%. Let's say that you win it. Okay, you win, you're up 2%. Then what do? You take your earnings of 2% here plus the original R. So you risk 3% on the next trade in order to make 6%. And let's say you do, boom, now you're up a total of 8%. So it's the same concept. It's a little bit more conservative, obviously, but it's the same exact concept. Okay, you're just going to try to win 2 trades in a row. And when you do that, you get this windfall of profitability coming into your trading system, which is really, really cool. Now, the other thing that this is really great for is for prop trading firms. Okay. If you're not familiar with prop trading firms, basically, you know, they have these challenges and basically they're capital firms. So if you're unfamiliar completely, they basically have a whole bunch of money. And if you can prove to them that you're a good trader, then they'll actually fund you with like, usually generally like up to like around $100,000. And it's really great because you're risking somebody else's money. And so it doesn't matter really if you lose it, and you also have a higher capital balance, so you can make a lot more. But the reason this is great is because they usually have these challenges where you need to make like 10% in a month. And if you do a 1-to-3 risk to reward ratio, you can get there really, really quickly with asymmetric compounding. I mean, I can't tell you the number of people that we have in our group that have simply passed challenges and got funded $100,000 worth of capital by simply doing a asymmetric compounding model. And they've literally done it in 2 trades. We've had people that are brand new traders come on board, and literally in like 2 trades, they've passed the challenge. How? Well, they did this. They risk 1% in order to make 3%. Okay, and then their total account is up 3%. They do it again and they go risk 4% in order to make 12%, and they win that trade. They win 2 in a row right off the bat, and boom, they're up 15%, which is more than 10% they get funded. Oh yeah, and by the way, if this video is helpful, go ahead and click subscribe and like this video as well, so that way you can get more helpful videos like this to make your trading easy, lucrative, and fun. Okay, so if you're not familiar with this concept of prop trading or using prop firms, then we have a whole playlist on our channel. I'll include it in the card right here so you can watch and see how tons of other people are doing that, getting access to insane capital, as well as you can check out this video right here where I did a comparison of the top 5 best prop trading firms and the easiest ones to pass. So go ahead and watch that right now.